I think we all like to think of ourselves as being very rational, and any strong beliefs or understandings that we have are based on something that we can truly stand behind as being fact. But what happens when there's overwhelming evidence that confirms something we're convinced is the truth is actually not true at all? This is where cognitive dissonance comes into the equation, and it's a really strange quirk that we have in human psychology. But the problem for us as traders, and for any other area in our life where we want to be improving and optimizing our performance, is that it can really stop us from realizing our mistakes, learning from those mistakes, and continuing to get better. So let's get stuck in and explore that. Towards the end of 2010, the US Federal Reserve had just announced that it was going to embark on its second round of quantitative easing, nicknamed QE2. That meant that it was effectively going to start printing money again in an attempt to support and stabilise the economy. However, not everyone was entirely supportive of the idea, and it gained quite a lot of criticism. Perhaps most public of all the criticism was a group of renowned economists who were the leaders in their field. This even included billionaire fund managers like Cliff Asness and Paul Singer. They wrote an open letter to Ben Bernanke, who was at that time the chairman of the Federal Reserve, good old Ben Bernanke, who always looked like he was on the verge of tears, and they paid a lot of money to post the letter as a full-page advert in the New York Times. Bold move. In the letter, the economists say, "We believe the Federal Reserve's large-scale asset purchase plan, so-called quantitative easing, should be reconsidered and discontinued. We do not believe such a plan is necessary or advisable under current circumstances. The planned asset purchases risk currency debasement and inflation, and we do not think that they will achieve the Fed's objective of promoting employment." As was noted by Matthew Syed, the writer and researcher, at the time of the letter, the inflation rate was at 1.5% and the unemployment rate was at 9.8%. However, after 4 years, in 2014, the inflation rate had not only stayed low, but it had actually fallen to 0.8%, and the unemployment rate had also dropped to 6.1%, as the US created jobs at the fastest rate since 2005. Needless to say, in that amount of time, the claims made by the economists had certainly not materialised. In fact, the opposite had actually happened. So, how do you think these famous and highly respected economists reacted? Well, Bloomberg set out to find out in 2014, and surprisingly, the economists they interviewed did not accept that they got it wrong, and in fact, most of them even thought they got it absolutely correct. So rather than just accepting that inflation and the unemployment rate had fallen, they instead looked for evidence to justify that they were correct. This even included one economist claiming that inflation had increased, but you have to look at Wall Street to see that it's increased on Wall Street. In other words, the stock prices are going up, which is clearly not what they intended from their initial letter. You can rewind and have a look at it again. They're not talking about stock prices. These economists were displaying signs of cognitive dissonance. So this is a term that was proposed by Leon Festinger in 1957, who pointed out that humans strive to have consistency in their psychology. And when that can't happen, such as when there's compelling evidence that shows that they're wrong, this is psychologically uncomfortable. So, in those cases, rather than accepting the evidence, they'll instead either change parts of their original idea to make it appear to fit the evidence, right? Changing their story a little bit, or actually avoiding accepting the evidence or even facing it whatsoever. So a great example of where you can see this happening around you every day, especially at the moment, is in politics. And I don't necessarily mean the actual politicians being lying politicians, but the people who vote for them. It seems that once someone has decided on who or what they're voting for, they somehow disregard all evidence that it's a bad decision. Or they're going to be more inclined to ignore someone's shortcomings if they're voting for them, even though it's obvious to everyone else who didn't cast their vote. I think we can all find examples of where this happened recently in the US election between Trump and Clinton, and of course in the Brexit referendum in the UK. Now, unfortunately, this cognitive dissonance can be really harmful, and particularly for us as traders. It can lead to losses, it can hold back our progress, and many other things. Now, in terms of the losses, I think it's pretty obvious if we take a look at the example of the economists for their letter to Ben Bernanke. There are many times when we'll do our analysis like they did and be certain that the market's going to do what we expect it to do. And then it doesn't, and we can't figure out why that isn't the case. There might be heaps of evidence telling us that we were wrong with our analysis, but we just can't see it, and instead we're going to cling on to the evidence that sort of works in our favour. This is a surefire way to blow your account and to end up broke. Just ask the people who, quite rightfully, claim that the stock market can't carry on rising forever and it's being propped up by Fed stimulus. Well, they might be right, eventually, but it's been the wrong move for years now, as we've seen a massive bull market, and people have practically set fire to their trading accounts like pyromaniacs trying to catch the top of it and to short it. Been there, done that. I had a love affair for a long time a few years ago with Euro, but because of my cognitive biases about what I think is going to happen, it led me to mistiming it and shorting it too early. Luckily it got there in the end and I made a tidy packet from that trade, but I think I'm still catching up on my sleep after all these years. That's why probably I look like a badger all the time. It's that Euro trade still. But look, that's just one issue and we can resolve that one by following our good old adapt like water, absorb like a sponge approach, which we've discussed before on this channel and we talk about it on the online course. And in fact, we're going to be covering it again in a few weeks' time on this channel, which I seem to be saying quite a lot, but we have a lot of things coming. However, the more important issue with cognitive dissonance is how it can restrict our growth and lead us to no longer improving. Now, that is a disaster. Losses from your account balance can be recovered, but if you can't keep improving, you're not going to make that happen. So let's think about this for a second. Imagine if you lose some trades. There may be some clear evidence that there's something you're doing that isn't working. There's something consistent. Or perhaps even more dramatically, the whole system you're using might not be working. But if, for example, you had a profitable run early on with the exact same approach, you might not be able to accept that there's anything wrong with the way you're trading because it worked before, it should be working now. But this is where cognitive dissonance is holding you back, because the only way we can improve is if we realise where there are mistakes and start focusing on those mistakes so that we can start fixing them. Instead, in these situations, people usually start trying to find other things to blame. Oh, the market wasn't moving in the way I wanted it to today. Oh, if it wasn't for that economic data release, then the trade would have been fine. That screwed everything up. Or here's the best one that investment funds use. It was a black swan event. These don't happen often. There's no way to predict this happening. Yeah, sometimes the professionals are actually the worst. In fact, that's a key factor of cognitive dissonance. It was discovered even in hospitals. So with hospitals, they started being investigated for mistakes. And it was found that doctors are so educated and put on a pedestal so much that they consider themselves to be infallible. So when there's a mistake, even a preventable one, they refuse it exists and think it must be some other freak occurrence instead. Therefore, they can't improve in the future and they can't help the progression of medical practices. And you can imagine how many lives have been lost as a result of that. It's not stubbornness, it's cognitive dissonance. So we can't allow ourselves to fall into that same mistake. We need to accept evidence with an open mind and realise that our trading can only improve if we look at where we're going wrong. If our aim is to be a profitable trader, there's a very important fact we need to accept. No one can trade perfectly. It just doesn't work that way. So in that case, we need to analyse the mistakes we make and we can't hold on to any beliefs or ideas about our trading too strongly. If there's a way to test it, we should test it. In other words, if something is testable, we should test that and let the evidence speak for itself. And that includes our results. That's the test in itself. But anyway, we'll leave that there for now. As I mentioned, we have got some videos coming up which will help you even more with this concept, but there are a couple in particular that I think you should check out. So in the description box is a link to our series on becoming a great trader. It's just 3 videos, doesn't take long to watch, and the last one in particular will help you with this area of mindset and psychology. We also have a video coming out next month which will be talking you through the best ways to learn from failure and mistakes, a topic everyone talks about. We'll be talking you through an approach that's used by scientists. But until then, if you like this video, please do leave a thumbs up. I also always love to hear which parts you enjoyed most or which parts you found most useful. So please leave a comment letting me know that. Subscribe for more videos and check out the description box for all our social media links and a link to join our free inner circle. It's been an absolute pleasure talking to you. Take care and have a great day. Bye bye.